So, good afternoon, everyone, and welcome to the second installment of the Client Fund Entrepreneurial Elevation Series, where we delve into the critical topic of personal financial literacy. In the dynamic world of entrepreneurship, understanding personal finances is not just advantageous, it's essential for navigating the complexities and uncertainties that come with starting and scaling a business. And for those of us who are not entrepreneurs, financial literacy is a critical skill that impacts every aspect of our lives, from managing daily expenses to planning for long term goals and achieving financial independence. So, before we get started, let's begin with some introductions. I'm your host, Thomas Gorman, and I'm the Client Success Coordinator here at the Client Fund. And joining me to lead the discussion, we have two very talented and insightful financial professionals. First, we have Omar Valencia, who is a financial educator at Inversiones Hispanias. Also joining us is Nico Brown, who happens to be one of our community development loan officers here at the Client Fund. So, gentlemen, welcome, and thank you for being here today to share your thoughts and insights. Now, personal financial literacy equips us with the foundational knowledge needed to manage our finances effectively. It begins with mastering basic financial concepts such as budgeting, saving, and investing, which are not only crucial for financial stability in our personal lives, but can also directly impact the financial health of our business ventures. By understanding these principles, entrepreneurs can make informed decisions that align their personal financial goals with the strategic objectives of their business. Furthermore, personal financial literacy fosters discipline and foresight, enabling us to plan for both short-term and long-term aspirations. It empowers us to assess risk tolerance, manage debt responsibly, and build sustainable wealth over time. These skills are invaluable in sustaining financial stability throughout the various economic cycles and unforeseen challenges. So join us today as we explore the principles of personal financial literacy. Together, we will uncover the actionable strategies and practical insights that can empower you to achieve the financial stability personally and drive success professionally. Let us embark on this journey to equip ourselves with the knowledge and tools needed to thrive in the entrepreneurial landscape. And so today we are going to lead off with Mr. Nico Brown. He has some material prepared for us. So Nico, how you doing today? Looking forward to hearing what you got to say.
Hey, Thomas, thank you so much for the opportunity to come on the platform and just speak to potential borrowers and then also individuals at all types of level of finance, right? So we can just educate people all around, right? Education is like the most important thing we need whenever we start our financial journey. So what I'm going to do, I'm just going to start off by sharing my screen here so I can pull up my PowerPoint. Just let me know if you're able to see my screen.
We can see it, Nico.
Okay, perfect. Thank you so much. So I'm just going to hop right into the presentation. So what is financial literacy? So financial literacy is the confident understanding of concepts including savings, investings, and debt that leads to an overall sense of financially well-being and self-trust. So when we're thinking about receiving a paycheck, maybe our very first paycheck, sometimes we don't understand why is it important to really know where each and every dollar of our monies should go, and nor is it something that we're kind of taught, right? But the reason why it's important is because we make financial decisions every day, especially as an adult. You make so many financial decisions when it comes to maybe family expenses or even just paying bills. Nearly every major life decision has a financial component to it. So when you think of that, that's something that's very important that you need to think, wow, if every financial decision I'm making in life has a financial component to it, shouldn't I know how important my financials are and what should I do to kind of make sure that at the end of the month I have enough monies. So another thing to consider when we're thinking about the financial literacy being important is to constantly making the same financial mistakes will cost you sometimes in the future. So when we're looking at budgeting, which is something we're going to get into a little bit later. Um, and then also just a strong foundation of financial literacy can support various life goals, such as saving for education, retirement, debt, and even running a business. So here's some statistics we can kind of go over, right? And so when we're looking at the statistics, we're looking at only 57% of adults in the United States are financially literate. Only 23% of adults ages 18 and 29 have credit card debt that is 90 days overdue. 33% of Americans have $0 saved for retirement. And then we're looking at 44% of Americans don't have cash over $400, $500 for emergency savings. So when we're thinking about these statistics, it's like, man, I need to probably save a little bit more, right? Or I need to pay my credit cards on time. So things like that. Um, One part that's really important that maybe some people don't think about is banks, having a banking account, so establishing and actively managing a banking account is a fundamental to developing your financial literacy. What is the basics of a bank account? Why do we need one? So we need a bank account so we can kind of secure our funds. It's a great way so we can manage our monies and receive a debit card or maybe apply for a credit card to use that for our continued usage. Writing checks. I know a lot of people nowadays don't write checks, but then you have the ability to probably go into a bank and get a check printed, right? Using an ATM. So whenever you have an actual bank account, a Wells Fargo, Bank of America, Pinnacle, you have a bank account, you can actually go to the direct ATM. And sometimes we don't think about maybe the fees that are being charged for using non bank ATMs. So those fees can kind of add up. So we want to see where we can kind of save money, right? But then also whenever you're buying or renting a home, when you're buying or renting a home, they want to see your bank account. They want to see, how much monies you have saved in those. So something maybe like a Cash App or something like a Venmo, that's not something they're looking to see. They're actually looking to see an actual bank account. Okay. So, receiving paychecks from your employer is something that you can do in a bank account, and then also earn interest on your monies. So, what are the types of banking accounts that we're looking at? So, when we're doing the research here, we're seeing two different types of banking accounts, and we see retail banks and we see credit unions. So, what's the difference? So, the retail banks is a for profit owned by shareholders, normally have a higher interest rates on their loan, lower interest rates on their savings accounts. Fees are often higher. You have higher minimum balances requirements, usually have more branches and ATMs, and it's FDIC insured. So when we're looking at the relationships that you're having with your bank, I would like to comment that it's very important that you find a bank that kind of fits with you, fits with your budget, fits with your family, because all banks are different, right? So you can go inside of a bank and they might have certain requirements that you can use so you can minimize on the fees that you could possibly get, right? But then when we're looking at credit unions, we're looking at nonprofit institutions. Membership is required. We're looking at lower interest rates on loans, higher interest rates on savings accounts. Fees are usually lower, lower minimum balance requirements, fewer branches and ATMs, and then they're NCUA insured. So, whichever you choose, whether it's retail banks or whether it's a credit union, it's always good to go in there and just, build a relationship with your banker and know which account will better fit your needs. Okay, and then we're going to get into the different types of checking, personal checking account versus business account. So when we're looking at, and we're not going to go too deeply in this because again, we want to partner with our banking partners and build that relationship. So please go inside of your bank, but just to generalize it, right? When we're looking at a personal checking account, the personal checking account is highly accessible. It allows many transactions per month without fees. You get debit card and checks. Usually, it's a non-interest bearing account. Sometimes you do have some that are interest bearing, depending. Automatic payments that you can get out of your account, ACHs, direct deposit, usually no minimum balances, maybe because of a direct deposit that you could have with your account. And then when we're looking at business accounts, we're looking at something very similar to the personal checking accounts, but then you can actually keep your money separate, right? So when we're looking at business statements, business banking statements, for sure, me as an underwriter, I'm looking to make sure that my clients aren't commingling funds, which is something that's very important, especially if you're looking to get in business, that you're maintaining your personal account personal and your business account business. Okay. So it allows you to, whenever you're doing business, accept credit card payments and just have everything neat and organized and for your business. It allows you to come with more legal protection for your personal checking accounts, allows you to set up different permissions for different users and set up foundations for building business credit. Now, when we get into the different types of savings account, again, we're not going really deep, just basic knowledge about the different types of savings accounts here. What we're looking at is a savings account and then a money market account, excuse me. So we have the savings account, which is an interest-bearing account. I mean, usually it's a lower interest rate that we're looking at there. You have lower accessibility with these accounts on average. With a savings account, you don't want to use it for any type of payments, right? You don't want automatic payments coming out of the savings account. The savings account is meant to save, right? And so on average with this, you're only able to do about 6 to 7 transactions per month. Again, check with your bank, but you don't want a lot of transactions coming out of this account because it's meant for savings. And then with this one, you do most of the time have a minimum balance requirement. Now, when we're looking at the money market accounts, we're looking at a higher bearing account, right? So we're looking at an account that sometimes might depend on what tier that you are. That depends on the interest rate that you're probably receiving with this account. With this one, it normally has a higher minimum balance requirement. And oftentimes these accounts, like I was mentioning, have tiered interest rates. Now, another thing when we're thinking about managing our funding is about budgeting. Sometimes we've probably heard this word before, but we don't really do it when it comes to budgeting. But literally, I see budgeting as just sitting down and writing down what you have coming in versus what you have going out versus any type of dreams or goals that you have coming in there. Okay. But budget is an estimate of the revenue and expenses for a specific period of time. Um, Things to know when it comes to budgeting is income and expenses, needs versus wants, spending discipline, and prioritizing all of your things. So when we're looking at budget, I would recommend that you just write everything down. So everything that's a need, write it down. What's a need for you? Okay. You need a roof over your head, you need lights, electricity, right? So those are needs. What are wants? Wants are things like, oh man, I want the new iPhone 16, right? So those are things that you can kind of hold off on, maybe start a savings for that because you're like, hey, I want an iPhone 16. Let's go ahead and start saving for that because that's not a need, that's a want, right? So steps to do your budgeting step by step is just determining your monthly income, calculating your monthly expenses, set achievable goals, pay down your debt, paying debt, student loans, saving for home ownership, student loans, saving for retirement, tracking your spending, and then track and then stick to your budget. I know sometimes it could be hard to possibly stick to that budget, but consistency actually pays the bills. So just make sure that you're just remembering the reason why you're starting this budget, and then just go with that. So budgeting tools that could help you is like the old school pen and paper. We have spreadsheets, you have Google spreadsheets, things you can probably just Google and just come up for you. You have SoFi, and then you have other budgeting apps that are sometimes built into your banking app that you can just download it. It connects to your banking app and it allows you to start a budgeting. So, I mean, on that part, you just want to make sure it's a right app for you, but you can easily have that coming through and see where you have your money coming in and going out. And a lot of banks now actually have this tool kind of built into their online banking. So that's something else to kind of check out with your bank as well. All right, so the next important topic is credit. Okay, I'm not going to get too deep into credit because you want to make sure you talk to a credit professional that's licensed. But just generic information about credit is credit is the ability to borrow money with the promise that you'll repay it in the future, often with interest. So when I think of credit, sometimes I think about you use credit for things that maybe you can't afford right now, right? It's pretty much the value of kind of paying for things right now instead of saving it and eventually paying it. But then this can be a really good tool as well for you to help you build your credit. So let's get into it. So the different types of credits that we have are revolving credits, installment credits, and then open credits, right? What's a revolving credit? So revolving credit comes with capped limits and can draw on until a limit is reached. They usually have a minimum payment, but not a fixed payment schedule. Installment payments are paid in lump sums and repay a predictable installment over a set schedule. And then your open credit allows you to access services and repayments is required in full at the end of the period. So when I'm thinking about that, I'm thinking more so like a line of credit, right? So I know a lot of banks now sometimes don't do line of credits, but you do have lines of credits out there that's available for you that you can use. All right, and so with credit, what we're looking at is how credit is scored. How is it calculated? I think everyone kind of wants to know, like, what is it I can do to better my credit or make it look good for like that loan application that I'm looking for because I want to purchase a home, right? So what's really important for us in the CDFI world is the history of your credit. So how are you paying back your credit obligations? So when we're looking at this, um, payment history is 35% of that credit score. Your new credit is 10%. Your credit utilization, you just want to make sure that you maintain that, like with your credit cards, maintain that at a 30%. Your length of credit history, that's another thing. So that's 15%. And then your credit mix is 10%. Okay. So what is a credit score? A credit score is a prediction of your credit behavior, such as how likely you are to pay a loan back on time based on information from your credit report. Okay. So I think if you just remember these like little key things here about paying your credit card on time, um, don't use over 30% of your credit score. Um, Make sure that you do have a mix of credit, but then also that you're being healthy with your credit. Don't overuse the credit just because it's available. I think you'll be set with that. Okay. Um, so how do we establish credit? So there's something called a secured credit card. And so most banks have this where you can go inside and you can kind of apply for like a secured credit card. This is you actually putting funds in like an escrow account where you can then later use this card for a purchase and then make on-time payments. That's a really good way to establish credit. Then we have a secure line credit builder loan. So this is a money lent as held by a lender or a secure account. The loan is repaid in installments, and the payments are reported on the credit report agency. Then also you have a cosigner. Sometimes a parent will probably go in and say, "Hey, I have a credit card or I have a car. I want to go ahead and co-sign for my child." And this is a really good way for young people to come in and just start their credit because they have their parents there kind of leading them and guiding them. And then we have become an authorized user on our account. So the authorized user, meaning you can get a credit card, meaning I can have a credit card, and then I can have you as a authorized user. Now, with this, it allows you to use my credit, but then you won't be affected at all, right? So I've seen this mainly on spouses, right? Husband and wife, or maybe the parents have something for the kids, where they're authorized user on the card, but they don't have any credit obligations to it, right? And then we have here, get credit for current bills that you pay. Most of the times, of course, if you pay your bills on time, then you won't be credited to the bureau, so that's a good thing. But then there's a lot of utility bills or a lot of different bills that offer you to actually pay, and then they will report that history to your credit bureau. So how to maintain a good credit standing. So a lot of things I mentioned prior, which is the pay the bills on time, keep older accounts open. Just be careful about closing things out, because anytime you call and close, sometimes or most of the times what happens is that drops your credit. So you just want to let it kind of fizzle out, especially if there's no annual fees or on anything. Monitor your credit report, keep a low balance, especially on those credit cards. Only apply for credit when needed. Maintain a emergency fund. Manage your debt to income ratio. All right, so now we're getting into interest. Okay, so an interest is a rate of the interest is the percentage of interest you earn or pay as applied on your principal balance. Okay, so simple interest and then compounding interest. What's the difference? So let's look at this. Simple interest is compounded solely on the on the principal sum of the loan. The interest remain constant throughout each period. The interest does not accrue interest, commonly employed for short-term loans or investment. The growth sometimes maintain a linear trajectory. And then when we're looking at compounded interest, it's interest is calculated on principal sum as well as on accrued interest. The amount of interest increases for each period. Over time, the growth is exponential. And then compound interest is very common for savings account and long-term investment products. So those are things that we're going to talk about soon whenever Omar comes up. So of course, we're not going to hit too deep into those, right? All right. So the do's and don'ts of credit and interest. Do's, we have make additional payments towards your principal balance of debt when possible. So like those credit cards, right? If you get a bonus at work, think about, hey, can I make an extra payment to my credit card, right? Um, Put your money into accounts that bear interest and securities that will appreciate in value. Automatic payments towards debts and contributions towards savings when possible. Be sure to keep your oldest credit accounts alive. Um, Use rewards and cash back to pay down the balances. Don'ts. So make minimum payments on credit accounts. Now, if that's all you can do, make the minimum payment. But if you can just do a little bit more, I think a little bit go a long way. Okay. Make payments after the due date or skip payments. Um, Make large purchases on credit cards that you can't immediately pay off unless it's an emergency. Use one credit, just use one credit account to pay off another. Max out credit cards and seek financing from predatory lenders. So those are things you want to be very cautious of or don't do, okay? What is predatory lenders, right? So predatory lenders, their practices are maybe creating like balloon payments at the end of loans, or having excessive interest rates or hidden fees. Um, not checking credit, asset-based lending, loan steering, lack of transparency, loan flipping, reverse redlining, negative amortization. So especially in lending, whenever we're looking at small businesses, we want our clients to be very cautious of the predatory lenders. In some cases, I've seen where you're making a 400 or sometimes even a $2,000 payment each week, and unfortunately that really hurts the business. So stay away from predatory lenders. Common predatory lenders is payday loan lenders, title loan lenders, supreme lenders. All right, so now we're getting to the end. The final words here, what I would say is always try to minimize the amount of interest that you pay. Um, and most definitely make sure that you have a banking relationship with your bank. Any questions whatsoever, build that relationship with your banker, ask them questions. They're going to be your best resource, especially when you're just starting out, maybe just starting with that business account, or even whenever you're starting out with your personal account. Okay. But thank you guys so much.
All right, Nico, thank you so much for that. It's always enlightening whenever you present something. And with that, we're going to hand it over to Omar. Omar is going to talk to us about investments. So with that, I'll hand it over to you, Omar.
Thank you, Thomas. Wonderful job, Nico. And I'm very honored and excited to be on here to be able to share this incredible information with y'all. So let me just get right into it. So, as mentioned before, the organization that I founded and I work with is Inversiones Hispanas. And though I do mainly focus on the Hispanic market, I am always more than happy to share this information with anyone and everyone to educate, because unfortunately financial literacy is not common knowledge. So that's why we're here, to make sure we make those changes. So the first thing I want to talk about is the Rule 72, riffing off immediately what Nico was already talking about interest rates. And this actually helps you understand the power of compound interest when you're using it on your side, right? The scary side is the credit cards and debts, but the exciting side is when you're investing, right? So as Nico had mentioned earlier, bank accounts can bear some interest, but typically and historically, it hasn't done well, especially nowadays, not as much as in comparison to investments. There is no comparison. But if we were to go back 50 years, it was very common for bank account interest rates, like a savings account, to generate you 3%, right? Nowadays, it's rare to find, but back then it was very common. And let's say we could go back 50 years in time to guarantee that 3% interest rate. And let's say you put away $10,000 and you let it grow for 48 years, working towards your retirement. So after all this time, you would think that money would grow to be a good amount for you to be able to rely for your retirement. Well, we come to find out it only grows to be about $40,000. And let me explain why. The rule says whatever interest rate you have, when you divide it into the number 72, it tells you how long it takes for your money to double. So that means 72 divided by 3 is 24. So at a 3% interest rate, it takes about 24 years every single time for your money to double. Now, I don't know about you, but I don't think we all have that many 24-year periods in our lives. So that's way too long to wait. And the second is nobody can retire off of $40,000. So then typically when we go out into the workforce and we get a job and we're looking for benefits, a 401k is one of them. And 401ks are fantastic. The problem is most people never really dig in to learn how they can make the most out of it. What funds are available? What is the matching? Or is there a Roth option? There's so much information that's so valuable to people, but most people never take the time to learn it, whether it be HR or whether it just be the benefits package is huge and no one wants to take time to read a giant package. So when everything's kind of on autopilot, people generally tend to get about a 6% interest rate off of their 401k, though they could do more. But when everything's kind of cookie cutter standard, it's about 6%. So let's compare that same 10 grand. Most people think, okay, well, if I double my interest, I should get double the money. But this is not simple interest. This is compound interest. So now it's 4 times as much, right? A lot better, still not enough to retire. Now, if people were to really take advantage of the 401ks and see the funds that are available that generate so much more and invest outside and have IRAs or have retail accounts of their own, it is so easy and historically so doable to get 12%, right? And this is just how big of a difference it makes, right? So from here, we went 4 times as much. And we would think, okay, maybe another 4, or maybe we could double that and say maybe 8 times as much. So we're thinking probably at $1 million would be what that 12% would generate. But the rule, 72 divided by 12 is 6. With that money doubling every 6 years, that 10 grand would turn into $2.56 million. That is something that everybody can do. And the thing here is that you don't need 10 grand to start, right? Unfortunately, there are some institutions out there that the starting point is 100 grand or 250. But there are organizations out there that can help people start investing at $25 a month, 30 a month, 50 a month, 100 a month, something, so you can at least get started, because that's the most important thing, is to get started as soon as possible. And I'm going to hit that in a second. Now, most people don't just put a lump sum away and let that grow, right? Usually people have a plan. If they have a goal in mind, whether it be retirement or a new house, new car, start a business, they want to put something consistently a month away so it's easier. Nowadays, if we were to put that money into a savings account or a checkings account, not all of them, right? You have to check on your specific bank, what they offer, but typically it's about a 0.01% interest rate. So if we get that 0.01% interest rate, let's say for 15 years, you focused on putting away $100 a month. After those 15 years, you have 18 grand, and that interest rate gave you an extra 13 bucks. Or if you put 250 away for that same 15 years, you now had $45,000, interest generated you $33. This is how big the jump is from saving to investing. Because let's say you only got a 9% rate of return, which is below average. Your money more than doubles, because now about 53% of this total balance is interest, right? The $100 a month made you an extra 20,000 because you invested it. It's that interest, right? That 250 a month made you an extra 50,000 on top of what you put in because you invested it, right? So that's at 15 years. The difference is even bigger at 25 years, right? 100 a month, 25 years, 30,000. 250 a month, 25 years, 75,000. But invested, almost 75% of that money is interest. That's all money you would not have had you saved instead of invested. So this is kind of the quick and dirty rule, if you want to think about it this way. Whatever you invest a month, it's properly invested, right? And let's say you just getting below average rate of return, 9%. Whatever you're investing a month, 25 years later, you'll have about 1,000 times as much. So let's say you're putting 100 a month away, you're getting a 9% rate of return approximately. 25 years later, you'll have about 100 grand. 250 a month, 25 years later, you'll have $250,000. 500 a month, 25 years later, you have about $500,000. All right. So that way, quick and easy math to be able to do that, in case you don't want to remember the rule 72, but this is nice and easy. Now, this is a very, very important example as to just how important it is to start. So let's say we have 2 cousins. One started investing at the age of 22 and started investing about $540 a month. And by the time they were 30 years old, they stopped. Not pulled out the investments, but they just stopped contributing. But they let whatever was already in there continue to grow over time. And their goal was to have that money ready for retirement. The other cousin said, you know what? I'm going to wait until I feel well established so I can start investing. So they decided to start at age 30 and not stop until age 67, which is when they planned on retiring. So who do you think made more money in the end? The one who started sooner or the one who started later and contributed more? We come to see that even though the cousin who started sooner only contributed $52,000 in the 8-year time span, ended up with $2.4 million. The other cousin that waited an extra 8 years had to contribute almost $250,000 and got 2.2 million, right? Just that 8-year head start meant everything. Now, let's look at it a different way. Let's say your goal is to have $1 million ready at retirement, and let's say you want to retire at 67, which retirement, by the way, is not an age, it's a dollar amount. Once you have enough money that you can live without having to work, you are now retired. But let's say you said 67, I want to retire, I think $1 million is going to be fine. Though it's different for everybody. People want to live different lifestyles. So if you're 25 and this is your goal, $1 million at 67, if you're getting a 9% rate of return, all you have to do is invest $177 a month. That's it. It's not even $50 a week. But if you wait 10 years because you want a better job, you're going to have to start investing $448 a month. That's more than 2.5 times what it was originally. If you waited till you were 45, you now have to invest $1,200 a month. And if you waited until 55, you now have to put over $3,800 a month, because the less time you have, the more money you have to put in. The more time you have, the less money you have to put in, because now you have time on your side. You have time working for you, right? One last way to look at it, if you were to only put $100 a month towards an investment, it's averaging 9%. At age 67, you can expect to have about $566,000. But if you waited just 1 year, you lose out on almost $50,000. Wait 5 years, you lose out on $209,000. And wait 15 years, you've now lost out on $429,000. This cannot be stressed enough. You cannot pay the high cost of waiting. You need to start as soon as possible. It doesn't matter with how much, just start with something, right? So then the question becomes, all right, well, what do I invest in? Well, we've seen historically the best thing to invest in are mutual funds. And what mutual funds are is it's giving individual investors, just normal people like you and I, the opportunity to have their money managed by professionals. And they handle funds that are made of multiple companies, right? Well-known companies that you are now partial owner. You own partial stock of every single one of these companies. So as those grow, your funds grow, you get dividends, and they do all the heavy work for you. You can focus on contributing monthly, and then you focus on your life, your family, your vacations, everything else, knowing that professionals are managing your money. And it's not just a couple companies that are within mutual funds. The typical mutual fund has over 150 stocks in it, right? If you've ever heard of the S&P 500, that's the 500 largest publicly traded companies in the US. And that's an average investment, right? So that with that diversification, it helps so much lower the risk, which is exactly what we're talking about right now. So here's the big difference between stocks and mutual funds. So nowadays we have apps like Webull, Robinhood, and Acorn, which is great. Everybody has the tools and the opportunity to invest, but here's the problem. Let's say I sat down with you and said, hey, here are all the tools and all the equipment you need to buy a house, to make a house, sorry, to build a house. Here's all the equipment, here's all the tools. Good luck. How's that house going to turn out? If you don't have the experience, you don't have the knowledge, you don't have the blueprint, it's not going to go very well. So educators, advisors, and mutual funds work all together to say, hey, here's your plan. Here are the options. That money is going to be professionally managed. You now have a go-to person you can talk to. You worry about your life. Don't worry about your money. It's going to be fine. Because when you're trying to figure out what to do with stocks, it feels like gambling. Like all you see is the ups and downs, and you don't know which one to pick. It's high risk because maybe you're investing in 1, 2, or 3 companies. There's drastic ups and downs, and no one's managing it. It's all on you. So if you're a pro, you might do really well. But if most of us don't know what the heck we're doing, so odds are it's not going to go well. Mutual funds, on the other hand, the odds are in your favor. You're now invested in multiple companies, which lowers the risk. So yeah, there's still ups and downs, but it's a lot more tranquil. It's diversified. and it's professionally managed. So you don't have to worry about it. You don't have to be an investment guru to have a great return on your investment. Now, some people may say, well, what about real estate and what about gold? Great investments, you'll beat inflation, right? But here's a study done from 1978 to 2020. If you would have invested 100 grand in that time frame as a lump sum, real estate would have grown to a value of 600,000, so more than 6 times as much. Gold, 850,000, so more than 8.5 times as much. But if you would have invested in mutual funds, right, into the stock market, it would have been anywhere in between 12 to 13 million dollars. There is no comparison. No matter how many times the news will say invest in gold, invest in real estate, invest this and that and the other, history lays it out for us. And so some people then are afraid of, well, what about the losses? Doesn't the stock market crash? Hasn't there been crashes? Yes. But if we look at the history from 1937 to 2020, there's only been 20 negative years and the other 64 were positive, and it still generated a 10.5 rate of return. So yes, with every crash, there's always up, right? Out of every 10 years of investing, there's 2 or 3 years that the market goes down, but who cares? The other 7 or 8 went up, right? It's knowing that, okay, if it goes down, that's fine. It'll come back up because it always does. History has shown it over and over again. Doesn't matter whether it's the .com, whether it's 08, whether it's COVID, it always comes back, all right? Now, back to the gambling. Most people say, well, it's probably like gambling. What if I lose? Okay, well, if we compare it to actual casino games, there is never a 50% chance or more of you winning. It is geared for you to lose. Investments, on the other hand, shown from 1901 to 2020, if you invest just for 1 year, which is not recommended, if you plan on investing, it should be 3 years and beyond. Anything before that, that's what banks are for, right? That's what money markets are for. That's what savings accounts are for. But 3 years and beyond, it should be properly invested. So, but even if you just say, okay, you know what, I'm going to give this a shot, I'm going to start investing. 1 year later happens, you check your account. What's the probability that you made money? 74%. There's a 25, 26% chance that maybe your account balance went down, but there's already, just the first year alone, 74% chance that your investment grew. Give it 3 years, 86% chance it grew. Give it 5 years, 90% chance. Give it 10 years, 97, and 15 plus years and beyond, it is a 99.9% chance that your money has grown. This is why long-term is so important, right? So then let's also look at the best and worst case scenarios, right? We need to know what we're getting ourselves into and what to be ready for, so when things happen, we don't freak out. So from 1977 to 2021, 50 years, we've seen that in 1 year, the worst thing that has ever happened was a 43% drop. And the best thing was a 61% increase. In 5 years, the worst thing that happened was a 6% drop. Best thing, 28.5. In 10 years, the worst thing that happened over those 10 years is a drop of 3%. Best thing, it went up 20. In 15 years, this is the incredible thing, 15 years and beyond, the worst case scenario is you made money, right? Just like I said, that 99.9%, 15 years and beyond, the worst thing happens is that your money grew and that you beat inflation. Because when your money is in a bank account, inflation is depreciating it. You may see the same number in that account, but as we've all seen, especially these past few years, everything goes up in price. So your money should grow and beat it. Otherwise, we're just going to have to keep on working more. And raises typically don't happen that often, or we just have to keep on trying to find better jobs or going back to school and getting into more debt, which makes no sense. So put your money to work. Just as hard as you are working for it, make sure it works for you. So very important concepts here, the 3 Ds of investing, right? This is something to always keep in mind. So the first D is discipline. Make sure that no matter what happens with the market, whether it's up or down, you keep on investing. You are here for the long game, okay? Diversification, right? Making sure you're not investing just in individual stocks. Make sure you are diversified because that lowers the risk. So who cares if, for example, Sears, Blockbuster, Toys R Us go out of business? That's why those professional money managers are there, to make sure that if those companies are going downhill, they switch them out with another one to make sure that you do better. Because if your accounts grow and these companies grow, everybody wins. And the last one is dollar cost averaging. So it's always best to invest month to month as opposed to just a big lump sum and let it grow. Because with the fluctuation of the market, if the market goes down and you're investing, that means you're buying more shares with the same amount of money. And if the market goes up, you're buying less shares with the same amount of money, but whatever shares you had before now go up in value. So to hit this home on dollar cost averaging, here's a perfect example. So let's say two investors started investing. Investor A, they're both investing 100 a month, but investor A happened to invest in something that over the past 6 months, which no one should look at their investments after 6 months, but let's just make it an easy example. In 6 months, it grew the entire time. Investor B was investing in something else that was 100 a month, that the first 4 months it dropped, and then it recovered the last 2 months. Just by looking at this, who do you think made more money? Let's see. So as we saw, investor A, cost per share was $10, so $100 buys 10 shares. And as that cost goes up, they're buying less and less shares. So now they have 42 shares, but they're valued at $20 each. So now they have a balance of 845, right? So that's the thing that's so important to understand about investing. It's not you're just putting money into an account and the balance just goes up and down. You are buying shares. You are buying partial ownership of companies. So those things have value, and that value is what goes up and down. So when you see the market go down, it doesn't mean, oh my gosh, I lost money. As an example, let's say you bought a house that was worth $100,000. And next year they find toxic waste, right? They dig up the ground, they find toxic waste. Now your home is worth less. Now it's only worth 50,000. Did you lose money? No. You still have the property. You still have the home. A hurricane didn't come and come crashing everything down. Like, you still have the thing. Now, if you sold it, that's where you lost. But who would want to sell something when it's at a lower value than what you bought it for if it was supposed to be an investment, right? So same thing with the stock market is if you're buying mutual funds or stocks or whatever you choose to invest in, you're buying things of value and those things fluctuate. So if the market goes down, don't sell, don't freak out. It just means now it's the time to invest more, or just wait it out, because every time the market goes down, it comes back up. All right. So on that tangent, investor B did the same thing, 100 a month. The cost was $10 a share, so they bought 10 shares. And as that cost went down, right, as the market was going down, they were buying more shares with the exact same amount of money. Now, here's the thing. Most people at this point would freak out. Most people would go, oh my gosh, my account value keeps dropping. But if you have this education and you have a coach or an advisor or somebody who's able to teach you and hold your hand every step of the way and say, hey, remember we talked about this? It's going to be okay. Because it always does. It went down, but then it went up. And as it went back up, they were buying less and less shares. So now they ended up with 125 shares. They're valued at $10 each. They have more now than doubled their money. It's $1,259 when over the 6 months, they only put $600 in. So this is why it's always beneficial to be investing month to month, especially in a fluctuating market, because when do we want to go buy stuff? When it's on sale. We want to go on Black Friday, right? The stock market works the exact same way. So don't freak out when that happens. It is meant to happen, and it is a good thing as long as you're investing month to month. All right. Now, the 3 different accounts you need. So first, you need to have an emergency account. Typically, that is a savings account or a money market account. This is money you plan on using in possibly the first 2 years, whether it be a vacation, whether it be presents, whether it be whatever you want it to be. This is short term, right? The short term account is really money you probably will use in 3 to 5 years. So that's really good to have a retail account, which those you will have to pay interest, or you do have to pay taxes on the interest once you decide to take out that money. But the great thing is it's liquid money. So yes, it fluctuates, but whenever you need it, you can take it out after 3 years. The wealth building account would now be your retirement account. So whether that be your 401k, IRA, traditional IRA, Roth IRA, SEP IRA for smaller businesses, simple IRAs, they are tax advantaged in one way or another. So they have the caveat that you can't really touch them until you're 59 and a half, because if you do, there's a 10% penalty. But if they're either tax deferred, if it's a 401k or traditional IRA, which means you'll pay taxes later when you withdraw, or they grow tax free, which is what a Roth 401k or a Roth IRA gives you, which it makes sure that interest is tax free. So by the time you are ready to retire and start withdrawing that money, what you see is what you actually get. All right. So taking a turn from investments, which is quite a bit of information, something else that is very, very important and unfortunately gets confused is life insurance. Now, the life insurance industry has existed for a while, and the way most people understand it is if somebody has a life insurance policy and they pass away, the policy pays out to whoever the beneficiary is. Most people believe it should only pay funeral expenses, maybe a couple other things here and there. But in reality, life insurance should be income protection or income replacement because it should replace the income that person was generating to make sure that the family that they leave behind have no financial worries whatsoever. So it pays off the house, it pays off the cars, pays off college. It gives them enough money for their daily expenses so that way, once they're old enough, especially the kids, they can handle being on their own. It gives them time to breathe and suffer in peace so that they can make adjustments. Now, the industry created something that's called cash value life insurance, which comes in many different names: whole life, universal life, variable life, IUL. They all have different names. They're all different flavors, but they essentially all work the same way. And this is how the industry sells it. They go, hey, mom and dad, you need 100 grand in life insurance. It's going to be $225 a month total, and it comes with an investment account that by the time you're 65, it's going to grow to be $76,000. And if you ever need this money, you can borrow it just like your 401k. People go, hey, great, 2 for 1. I love bundles. I already do that with my home and auto, right? Here's the very, very important information. That's the fine line in the text that most people don't read inside their policies. So this money is not your money. It's the insurance company's money. So if you ever want to use it, you have to borrow it, and you're going to be charged 6 to 8% interest. That's not benefiting you because you're borrowing it from the company. Second, this isn't taxed, right? They always say, oh, this is tax conservation. Well, here's the problem. The reason why it's not taxed is because your balance is always less than what you actually put in. So if you put 225 in a savings account and put 225 into this policy, you'll end up more in the bank savings account. You're better off just having the savings account. Third, let's say something happens to John. Mary only receives 100 grand, the life insurance coverage. The company keeps the 76,000 because in the fine print, cash value's middle name is surrender. So it's really called a cash surrender value. And in the terms and conditions that everybody signs, if the insured passes away, the beneficiary receives the death benefit, not the cash value. So who would ever want to pay for two things and only get one? This is why buy term and invest, the difference exists. So this teaches people you don't need to be insured until you're 100 years old, which is what the industry wants you to believe. You could go at any time. Why not be covered forever? Well, the reality is life insurance is only needed if you have people who depend on you financially, if you have debt, or you're not ready to retire. But the day that no one depends on you financially, the kids are grown, the debts are paid, and you have $1 million, $2 million or more to retire with, why would you need to keep on paying for life insurance? So meanwhile, you can get term insurance, get the coverage for the time frame you actually need it for. You can get a lot more coverage and at the same time pay a heck of a lot less. So what are we going to do with that difference? We're not just going to save it. We're going to take it one step further. We're going to invest it. And let's say you only get 9% on that 145 a month. You'd still end up with over $250,000. And now since the life insurance and investments are separate, the family can receive both. If John passes away in this situation, Mary receives the 250 from the life insurance and the 265 from the investments. Now she has $500,000 that she could actually do something with. She could actually live off of that and survive. So the industry teaches this. People need to know this. People need to know that keep life insurance and investments separate. Life insurance is if you die. Investments are if you live. You cannot combine the two. You can't die and live at the same time. They need to be separate. So please be very, very wary and very careful of any policies that include a savings or cash value or investment, because this is not a true investment vehicle. People sell this without an investment license because you don't need it. You need a real investment license, a real investment professional that you can look up on BrokerCheck to be able to help you with true investment accounts and real securities. Okay. Here are some perfect examples. I'm going to go through really quick. So IULs, this was a 37-year-old woman who was paying $170 a month, right, which is $2,040 a year, and she was covered for $200,000. Look at this. This cash surrender value, which is from the policy, had a zero balance for 12 years. Imagine paying $170 a month into an account and your balance is zero for 12 years. then it starts growing, but then it starts falling, and then it goes to zero. And once that balance goes to zero, everything goes to zero. Why is that? Well, IULs are actually annual renewable term, which means every year it gets more expensive. But if you're not paying any more money into it, now there becomes a gap between what you're paying and what it actually costs. No one's going to offer free insurance. They need to take that money from somewhere, and they take it from the cash surrender value. And once you have zero cash value, they now hit you with, hey, that's actually going to be $2,000 a month if you want to keep this policy alive. Nobody can afford it. They cancel it. They're left with nothing. So instead of paying 170 a month for an IUL, pay 28 a month for a term policy. You now have $142 on the side you can invest. Let's say you only get 9%. You now have $160,000. Whole life insurance is a lot simpler. This one does go up every month, right? This is a 40-year-old mother. She was paying $521 a month for a coverage of $300,000. At age 65, she was going to get $142,000. Some people go, hey, that's a pretty good deal, right? Well, good compared to what? If you're paying $521 when you could have been paying $53 a month and investing the $467 at 9%, you now have $577,000. You don't know what you don't know, which is why it's so important to be well informed and talk to somebody who has all their licenses, who can really give you the full picture instead of trying to lean you towards something that's going to make them a huge commission. So to organize this, step one of your financial house is making sure you have the proper coverage. You need to have term life insurance if somebody depends on you financially, because if they depend on your income and your income's gone, nothing else matters. Then focus on having a budget, as Nico mentioned, having an emergency fund, having a will, having a plan to pay off your debt, making sure your retirement is on track, making sure your kids' college is on track if that's something you want for them, and then anything else after that. Trust me, the big house, the nice car, the boat, it'll all happen once you do all of this first. So again, Omar Valencia from Inversiones Hispanas. There's my information. I'm more than happy to talk to anyone and everyone. This education is absolutely free. My appointments are absolutely free. And I really hope that y'all enjoyed all of that information and were able to learn from that.
Omar, thank you so much. That's not the first time I've seen that information, and yet every time I see it, it does resemble the first time because it's very clearly impressive information that the majority of us need to know, especially anyone who's getting into their own business, because you can't run a business if you can't run your own personal finances. It's just not, the numbers just scale up. They get bigger, the problems get bigger.
That's
Um,
right.
so, I really appreciate you presenting that information. And I hope everybody in the audience can take something from it. Before we wrap up, though, I do have a couple questions I just want to get you guys' thoughts on. Um, I'll start with you, Nico. Um, what strategies can entrepreneurs use to build and maintain emergency funds that support both personal and business needs?
Hey, thank you so much. So I think a strategy that entrepreneurs can use is maybe like a percentage system, if that makes sense, right? So we have income coming in, but why aren't we taking a certain percentage and kind of what Omar said, pay ourselves first, right? And so maybe have a pay yourself first budget where you're putting money aside to that way that money can accumulate for you. And eventually you might need not to even apply for certain funding, because then at that point maybe you're able to purchase that equipment on your own once you have those funds set aside. So yeah.
Right, absolutely. You got anything to add to that, Omar?
No, it's exactly what Nico said. It's paying yourself first. A lot of people will make themselves the last priority, unfortunately. And I totally understand of like, hey, I got to pay my mortgage, got to pay my rent, my bills, my food, everything else. But with people go, well, if I have some money left over, I'll put it to the side and I'll save it or I'll invest it. No, if you don't make it a priority, it's not going to happen.
Absolutely, absolutely. Um, and I think that's why so many financial advisors they tell you to automate your contribution, so you don't even have to think about it. It's not a decision that you make; it just automatically happens, right? Um,
Exactly.
so um, the next thing I'm wondering is, and Omar, you might see this a good bit. Entrepreneurs generally, we don't have an employer to offer us a 401k, and then a lot of times, you don't understand all the options out there for you to invest in, or how to get a retirement going when there's no one to help you with that. So, how can an entrepreneur, you know, fa save for their later in life plans, retirement or home or whatever, when it's really up to them to be able to navigate the environment and understand where they need to put those monies?
Yeah, so that's a wonderful question because here's a funny thing. For years on end in the U.S., the 401k was the only option for retirement aside from Social Security, and because of the rise of all the entrepreneurs, eventually someone came to the government and said, "Hey, not all of us are employees. What opportunities do we have to be able to invest towards our retirement because we want to retire someday too?" And so that was the creation of the IRA, whether it be a traditional or a Roth. Every person, whether you're an entrepreneur or an employee, you have access to an IRA. Now, if you have a business, you have access to even other business investing accounts as well, 401ks, simple IRAs, SEP IRAs. So it's just a matter of being able to talk to someone to help guide you and figuring out which one is best for you and your business, your family, your individual. But there's plenty of opportunities out there for people to be able to start that.
Absolutely, absolutely. And Nico, I'll hand the last one off to you because I know you deal with this, quite regularly. In terms of best practices for managing personal and business finances separately. One, why is it a good idea to do that? And then how do you go about doing that?
Okay, so the way you'll go by doing that, well, first of all, what I kind of want to start off is that whenever we get an entrepreneur or whenever you believe, hey, I'm going to go into business for myself, um, you need to start. You need to start that mindset with, okay, I need to go ahead and separate things. Even if you start off with maybe a savings account or maybe a checking account. And the reason being is because whenever you're looking for funding, right? Or even if you're not looking for funding, but even for tax purposes, you want to make sure that you're just keeping everything separate. It's always important because even whenever you're speaking with an accountant, they're going to tell you, keep it separate, right? So if you have all these individuals telling you, hey, keep it separate, then ding, 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 let's keep it separate, okay? So then what we can do if your business isn't maybe a business that's bringing in a net income of 50K or 100K, you're at the very start, you can do something like a savings account until you get to maybe having a couple $1,000s, then move up to a checking account. You know what I mean? So that's why I was mentioning that it's so important to have a relationship with your banker, know exactly what it's going to take for that business banking account so you don't get any fees because I mean we're in the business of making money, not paying out fees, right? So making sure that you talk to your banker, and if they say, hey, minimum balance is $5,000, right? I'm just saying that $5,000, right? Then you should go ahead and start to accumulate those funds in your checking account at that point, a personal checking account that you probably only just use for that until you can actually move it over to a business account. But then again, it's all about shopping around and finding the best bank for you. Because if you're looking for funding, whenever you are submitting in your bank statements, no one's going to go through and kind of pull out like a P&L, right? So a P&L is a P&L, a bank statement is a bank statement. So they're completely different things. And what we want to make sure that you're not doing is just commingling those funds, that you're probably, you have a net income coming into your business. The way we're going to find that out is by looking at your P&Ls, but then also verifying it with your balance statement. So it's really important to just keep everything separate.
Absolutely. And coming from the world of small business, I always took the approach that I never wanted my personal finances to have the same identity as my business finances because, when they're joined at the hip, business starts going down, your personal finances going down. And who wants that? It's just so much simpler to keep that stuff separate. It gives you better clarity in terms of your financial position. So I agree with everything you just said there, Nico. Great stuff. And I think that is about all the time we have for today. So I would like to thank you, gentlemen, deeply for being here today to speak to everyone. This is really important material for anyone, looking to learn more about investments or look into their opportunities. Please reach out to Omar. He put his information up there. You can get him very easily through those contacts, and have a conversation and see what your finances can look like in the future compared to where they're at right now. And so with that being said, we're going to go ahead and wrap up. And we'll see you guys next time on Climb Fund's Entrepreneurial Elevation Series. Thank you so much.